In this video, I'm not showing you 1, 2, or 3, but 11 price action strategies that you can use to take advantage of any situation in the market. So buckle up and let me take you for a ride. So the first strategy that you can use in the market is the breakout strategy. So what is the breakout strategy? A breakout strategy is a strategy that is very common, and it is used when you want to take advantage of a breakout in the market and you want to follow the trend. So let me show you how it works. So the market moves in terms of higher highs and higher lows when it comes to trends. So it moves something like this. So with a breakout strategy, what you want to do is you want to be able to capture the after the market breaks out and breaks above this higher high, you are most likely to see a bigger move to the upside, and you want to take advantage of this to make sure that you place your trades. So in this case, you can see that we have the market that is moving. This is GBP Canadian dollar. You can see that the market was making higher highs here and higher lows, right? So if you look at this, you're going to see that the market was breaking above its higher highs. So what we want to do is we want to make sure that when the market breaks up here, we place a trade. So what we do is we draw a horizontal line on top of this higher high here, and we wait for the market to go above this, and then we just simply buy after the breakout. So the breakout strategy is very simple. All we want to do is capture these higher highs, and then you can see that later on the market breaks out, and once it breaks out on the candle that the market breaks out on, we are going to place our buy trade. And in this case, you see that the market went on to place a good winning trade. After a few minutes again, you can see that we have a higher high, we have a pullback here, and we want to also capture the next breakout. So where do we buy here? We want to place our buy if the market closes again above this previous higher high. So it will look something like this, and then what happens most of the time is the market will just go ahead and win, because the market is already in an uptrend. The momentum is already going to the upside, so your chances of winning are going to be very high. So the breakout strategy, you've got a high win rate, and I'm going to show you a list of examples where the market has been respecting the breakout strategy. And you can also see that on this one chart, you could have placed the 3 winning trades and 1 losing trade with the breakout strategy, because this market is already trending. So if you capture the market that is already trending, you can get more trades on that. Right now, let's look at another example here. So you can see that the market was moving in an upside direction. Again, this is GBP Canadian dollar. You can see that the market was ranging here, and if you want to see how the market was ranging, you can see that we can draw a horizontal line touching the top of these candles, and when the market breaks to the upside, we are now looking for a buy trade. So what do we do here? We are going to place our buy trade. Once we place our buy trades here, we are expecting the market to go to the upside, but let's wait and see what happens in this case. So you can see that later on the market dropped and went to the downside. Why does this happen? Now here's what you need to understand. When you are trading the breakout strategy, you are going to see that your chances of losing are going to come when the market creates what is called a fake out. And a fake out is a fake breakout followed by the candle that goes below, and then the market moves to the opposite direction. So one thing that you need to understand when you want to trade the breakout strategy is that the market creates 3 types of pullbacks if you are in a trend. So the first type of pullback is called a shallow pullback. So we have the market which makes an impulsive move, and let's say a pullback, and then another impulsive move. So on the next pullback, if the pullback is very short, comes like here, and then it goes up, it will likely go to the upside, right? But if the pullback is deep again to this, maybe half of this impulsive move, you're going to see that the next impulsive move that comes is not going to go away if it breaks up here. And also, if this pullback, the same pullback, if it goes all the way to the lower side here and it tries to go to the upside, you are going to find out that that the market will have less chances of breaking, going in a strong move to the upside, which is exactly what happens here. You can see that the reason why this became a fake out is that we have this strong momentum which came here. So you can see that when this happens, right, all the buyers who were in profits right here are going to likely exit the market because people will think that the market have already reversed. So now we have less momentum of the market to go to the upside. So keep in mind that if you want to trade the breakout strategy, do not trade it after the market makes a deep pullback. If the breakout comes after a deep pullback like this, you don't place your breakout trade, right? So this is very important. Now let's move on to strategy number 2. Strategy number 2 is the range bound strategy, right? So this range bound strategy is a strategy where you want to make use of these deep pullbacks that I'm talking about, right? So if the market is moving to the downside, right, as we say, we can see an impulsive move pullback. It can be to the upside, but it will be opposite, right? And then it pulls to the downside. The pullback might be a shallow pullback coming here, or it can be a medium pullback coming maybe halfway here, and also it can be a deep pullback maybe going all the way to this point before it moves, right? We never know what is going to happen. But now in this case, what we want to do is, if we see, let's say the market is moving like this, right, and we see this is an impulsive move pullback, an impulsive move again, and then we see the market going all the way up on this pullback, going below this zone, because this is our previous zone. We'll talk about this strategy next. But if you see the market going all the way here, the next zone that we want to take care of is this zone here. This is where the market will likely go to. So we draw our horizontal line, taking this part here, and then we are waiting for the market, which is kind of ranging here, and we want to go to the downside. So the way that we'll place here is that we'll place our trade here, put our stop loss, and then we put our take profit. Your stop loss should be above this zone here, because if the market breaks this zone, started going, it eventually went to the downside, right? So let me show you another example. This is USD JPY. It's 30 minutes time frame, and now you can see that the market is moving to the upside, right? It makes a pullback, it moves again, and this pullback right here, it went below this zone and it went to this previous zone here. This is where you want to place your trades, because now you have created some kind of a range, right? Because the market have come here, it will likely keep going up, maybe down like this, and then maybe eventually break to the upside. But at this point, you don't know. What you just want to do is mark out this previous zone right here, and once you mark out this previous zone, you can now see that after this, the market will likely push to the upside. So I will be placing a buy order here, placing my take profit above, my stop loss below, because if this zone is broken to the downside, that means my trend have opposite, so I'm out of the market. But if it keeps going up, I will likely make profits. So in this case, you can see that this was another example of a winning trade. Of course, these are examples. There's gonna be times when you lose doing this, but this strategy also works very well. The risk to reward ratio is bigger, and also the win rate is average. So what you want to do here is you want to have patience to wait for the market to create these pullbacks right here. Don't rush into the market. Wait for the market. Sometimes you're going to see some pullbacks won't come back to your range, but then you just want to be patient and find that one good trade that is gonna change everything. Now let's talk about strategy number 3. The strategy number 3 is just almost the same as the two previous strategy, which is called the break and retest strategy. So what is a break and retest strategy? A break and retest strategy is a strategy where you want to identify the 1, 2, 3 move, but then you want to mark in a zone which the market most likely like to react on, right? So let me show you what this zone is. So here we have Great Britain pound versus New Zealand dollar. You can see that this market is moving to the downside like this. So for you to trade this strategy successfully, the most important thing that you want to do is to want to be able to identify an impulsive move and a pullback, right? So an impulsive move is a move, let's say the market is going in a downside direction like this, right? So an impulsive move is something like this, right, which creates a lower low, and then we have a pullback which comes back. Then you want to mark this zone and you want to wait for the market to push below this zone, and you have your 1 2 3 move, right? So this is what called a 1 2 3 move. We always talk about this. So for example, here you can see that the market pushes lower here, comes back up, and then pushes to the downside again, and you are looking at the market being right here. And what is your opinion? How do you trade this? So the first thing that you're going to do is you want to mark out this zone right here. So if the market comes back here, it might be a medium pullback. So remember, first we said if the market makes a small pullback and didn't come to this zone, you place a breakout strategy. Number two, if the market goes all the way to this zone, you place a range bound trade. And now when the market comes into this medium pullback, you can place a break and retest strategy, and it will look something like this. So when the market comes back into this zone, you're just waiting for like red candles that shows you that the market is getting momentum of going to the downside. Then you place your trades. Once you place your trades, make sure you put your stop loss above here, and then your take profit down below. And most of the time the market will likely go to the upside. On this same chart, you can see that the same thing happens here. After we have this winning trade, we have again another pullback, the market going to the downside, and then we mark this zone right there, and you can see the market comes back into this zone again. So you could again place another sell trade here, which was most likely going to be a winning trade. Now here's another example, GBP NZD. You can see that this market is moving to the upside. And how do we know that this market is moving to the upside? Firstly, you want to see these previous zones being broken. So whatever the market does here, if it breaks these previous zones, you know that we are in an uptrend. So if these zones are being broken here, right here, always know that we are in an uptrend. So first, you can see the market pushes up, makes a pullback, comes back again here, and then it breaks above. Once it breaks above, this zone is our zone of interest. So what we do is we draw our horizontal line here, and then you can see that the market pulls above this zone, makes a pullback, coming back into this zone right here. So it's coming back into this zone. So this zone here is broken, and then there's a pullback. So it's a break and retest. So it breaks here, it comes back to retest, and then we expect prices to push to the upside. So what do? We sell right here, and then later on the market went on to push to the upside. So these are just examples, and I'm doing this so that you can really understand and get this in real time. But also you need to be careful when you're trading in the real market, because you want to have patience to wait for the market to come back into these zones, and also you have to execute the trades when the market come into those zones. Now the break and retest strategy is very, very easy to use, and it's one of the most important strategies that I am using currently. I always place a trade if I see a break and retest strategy, because from my test and from what I've done before, I know that this strategy really works. Now the next strategy that I want to show you is what is called the flags pattern strategy. The flag is just a market that have a very strong move to the upside and then a range, right? And the range helps to build momentum, which makes this strategy very highly profitable. So let's say you see the market which makes a very big move here, a very fast move, and then at some point it starts doing this. And what is this right here? This is the battle between buyers and sellers, and this is momentum that is being created by big market players, and very soon you see the market breaking to the upside. This is what is called a flag strategy. So let me show you the flag pattern, how it works. So right now you can see on this chart that the market was moving to the upside again, and then you can see that if we draw our flag here, so we have a strong move right here. See this strong move, and then we start seeing some momentum. Now sellers are now starting to get into the market, and also there's people who are starting to take profits here, creating. So when you are in a buy trade and you take your profit, you are taking a sell trade, and it makes the market reverse. And there's a lot of people doing the same. There's a lot of big market players who are also adding their trades, and also they are trying to get as much trades as possible. So they wait for this type of ranges where a lot of people are taking profits and a lot of people are entering into the market. And then most likely what the market does here is it will just continue with where it was going. So you just want to place a trade like this, and then you wait for the market to do its thing. In this case, obviously, it was going to be a winning trade, because I'm trying to show you how this works, right? And if we look at this again, where again do we get the same thing, another flag pattern? If you look here, you can see after this strong move here, we get another flag again here. So this was going to be again another flag trade here. The market then went to the upside. We were supposed to place another buy trade right here. And then when the market comes here, it pulls back, and now we start to go to the downside. And you can see a strong move to the downside here, followed by a range. And we are likely going to place a trade. So what do? We mark out this zone. Once we mark out this zone, we know that the market have got a strong move from the upside here. Now we are likely to go to the downside. So here is how your trade will look like. And then this was going to be again a winning trade. Now you can see that this strategy, most of the time, if you get it right, you are going to reach your profit targets very fast, because after a range like this, the market will likely explode and make a bigger move, right? And let's move on. In the same example, you can see I just moved the chart to the back a little bit, and you can see that we could have placed again another trade here. We have a strong move to the downside, again a flag, a range after a strong impulsive move, right? So we said the market makes impulsive moves and pullbacks, impulsive moves and pullbacks. But what happens in the market most of the time is the impulsive moves are going to be sharp, but these pullbacks are not going to just be a few candles. Most of the time it's gonna be ranges like this. So this is where we take advantage and we place flag trades here. So in this case, you would do something like this, and obviously it's an example. It went on to be a winning trade. So you can see on one chart, this is again GBP and ZD. You can see on one chart again, you could have placed a break and retest strategy. You could have placed a flag pattern. You could have placed breakouts. Any type of trades that you wanted to place here, you could have placed those trades. The number 5 strategy is the double top and double bottom. What is the double top and double bottom? It is a chart pattern, but I'll take it as a strategy, because if you want to trade this strategy, you are mainly looking at the charts again and looking at the trend and understanding where the trend is likely to reverse and what is it going. So what happens here is, as I said, if the market is moving to the upside, it should create impulsive moves, pullbacks, impulsive move, pullbacks, impulsive move, pullbacks. So what happens is, for you to identify that the trend is still continuing, you want to see the market continuously breaking above its previous zones, right? But what happens if the market goes on and fail to break this zone and start to go to the downside? We create what is called a double top. And let me show you how it works in a real chart here. So now you can see that this market is moving to the upside, makes impulsive moves, pullbacks, impulsive moves, pullbacks, impulsive move here, pullbacks. This one is more clear. And then what happens next is that the market tried to go to the upside, right? It even went and break right here. And then the next candle that follows is taking the market back into this zone, right? So what you want to do is you want to mark out this zone and make sure that if the market breaks to the upside, it's a continuation of this big trend right here. But what if the market drops like this? It fails here. Now you can clearly see that, okay, maybe this impulsive move is not gonna break. So what am I going to do here? The next thing that you want to do is you want to identify this as your first top and then this as your second top. So we have top 1, top 2, and the next thing that you want to do is you want to draw a neckline. So this is called a neckline, and the neckline is going to be this zone here, because the zone that connects top 1 and top 2. So we have top 1 here, it reverses, comes here, go back again, and then creates what is the neckline. Some people call this the M structure in other technical analysis concepts. But now, once we see this M structure here, or this neckline here being broken to the downside, most likely the market is going to the downside. So as soon as it get broken, if it got broken with a big nice momentum candle that shows that the market has big selling pressure, we want to just place our trades right here. Place your stop loss above middle of this double top here, and then if you are conservative, you can place your stop loss above the tops here, and then it means you need to also place a bigger take profit. But then this is what happened next. The market breaks to the downside, and then you were going to win this trade. Now, there's two ways of trading this double top, because I want to show you another example right on this chart. So sometimes we are going to just trade the double top on top of a very big pattern, and most of the time this one have a lower win rate because most people will struggle to find the top of these zones. But then what if you combine this strategy with the break and retest? So let's say the market is moving like this, and then it makes a pullback, and then it goes to the upside, and then when it's coming back into this zone, you already wanted to place a trade, but then you see the market doing something like this, and then you have your W pattern or double bottom here. It means, number one, you are already in a bigger trend. Number two, you are on an area of value. You already have a strategy for this, also being confirmed by this double bottom, which makes it even more powerful and more likely to win. So I will call it the high probability trade, which is exactly what happens on this chart right here. Look at this. We first see the market which was moving up, and then it breaks below this zone. This zone is already an area of support or resistance zone, right? So we see now the market is coming back into this zone, and now it's likely failing to break it. So we're expecting a push to the downside. So what do you do next? You mark out this zone and you wait. Once you wait, if the market comes back to this zone, this is where you place your trade, which is exactly what happened next. But this is just an example so that you can understand what I am talking about, right? So you can see after the breakout of this zone, you're going to place your trade. Now you have your double top. So where is the double top here? Market pushes up, higher highs and lower highs, so that you understand. This is impulsive move, pullback, impulsive move, pullback, impulsive move, pullback, impulsive move, then you have pullback, impulsive move that fails. So we have top one, top two, it goes to the downside. We draw the neckline here. Now because it fails to break, that breaks the neckline, we sell. And then once you do that, the market was supposed to go to the downside, but then started on a reversal, which is the reality of the market. We pushed to the downside. That's exactly how you trade a double top and double bottom pattern. So let me show you another example here. This is also when it can be powerful. Now look at this market. We are in a very strong move to the downside, right? We have a reversal here. We have the market pushing down, and then these are the zones of interest, because we know that if the market reverses on this zone, we are waiting for it to break below if we are going to continue the downtrend. Also, we have another zone here which is very strong. So when the market comes to this zone, we are looking at this zone as a very big level of structure. So the next thing that happens is on this zone, exactly on this zone, what do you see? A double top pattern. So we have an impulsive move, pullback. Impulsive move fails to break this zone, and then now it goes to the downside, creating your M pattern. And it's happening also on a level of structure. And the reason why I put this example here is I wanted to show you that sometimes the double top and double bottom is not going to be created by like 4 or 5 candles. It might take a lot of candles in between, and this is when exactly you want to place a trade, because now you are waiting for the market to break below this zone, and then this is where you place your trade, which is going to either win or lose. But in this case, you can see we have a lot of confidence because number one, we have a strong level of structure. Number two, we are seeing a double top and double bottom. So don't trade this double top and double bottom in isolation. You want to make sure that the double top or the double bottom is happening on a level of structure or somewhere where you can have confidence that this is going to be a winning trade. Number 6, we have what is called the trend line trading system or the trend line trading strategy. What is a trend line? I think almost all of you know that a trend line is simply if the market is going to the upside, right? There's chances that we can be able to connect these previous higher lows or lower highs, whatever you call it. So if we can connect these zones, we are confident that if the market comes back into this zone again, this is a diagonal support or resistance zone. So we want to place our trades here, right? But I want to show you how to increase your chances of winning in this, right? So first of all, the first thing that you want to do is you want to be able to draw your trend line. So looking at the chart that is on the screen, where can you draw trend lines? You can draw trend lines in a lot of ways right here, and one of these ways is drawing a line which looks like this. This trend line touches the market once, 2 times, 3 times, 4 times, and 5 times. The longer it touches, the more likely it will be, the stronger it gets, right? But you don't want to wait for like 7, 6, 7, 8 touches. You want to be around 3 to 5 touches. That's when you want to place a trade. So if you look at this market, you can see that the market have been moving and have been touching this trend line. So now the market came back into this trend line, and we are a little bit late here. You should have placed a trade right here after this rejection, right? So on the trend line, you can see on this touch, there's a long wick to the downside showing you rejection. And also if you want to combine this with other things, and you can see that there is a green zone that I draw here, which shows you that this was a strong area of structure and the market will likely push to the upside. So what do you do here? It's a late trade here, but you should place a trade right here and expect prices to move to the upside. So most likely this trade is likely to push to the upside because we have a lot of factors here, but what makes you place the trade is that the market is respecting this same trend line that it has been respecting before, and later on you find out that this trend went on to win. Why? Because it was a high probability trade. So trend line trading system, you want the market to touch the trend 2, 3, or 4 times, and then you place your trades before it goes to the 5th or 6th touch. Now let's look at another example right here. Let's look at this market. Where can you draw trend lines? So can you draw trend lines right here? You can draw a trend line right here and you can say the trend line is broken. You can also draw a trend line right here which was broken, so it's invalid. So where do we likely going to draw a trend line? I would say right now where I can draw my trend line is right here, right? Because I want 1 touch, 2 touch, 3 touches, 4 touches. And also I can see that if I also come here, I can probably get something right here to just confirm that maybe this is a channel that the market is respecting. So I can trade at this point. So what is likely going to be my trade? So when you're trading trend line strategies like this, most important thing that you want to see is a long wick on the trend line. So just like this wick here, rejecting the market to go above the trend line, this is where you want to place your trades. And then if you also look at it, you are going to see that there is a strong level of structure which was being respected here, and also the market is rejecting it right on the trend line. So there's huge chances that the market is going to drop to the downside, which is exactly what happens. So the market also continued to respect the trend line until it eventually broke it right here. So this is called the trend line trading system. It's very easy to use, and let me show you one more example so that you can really understand. So look at this market right here. What is happening? You are going to likely place your trade. Can we say this is a trend line? Maybe we can say, okay, this is a trend line. This is a first touch. We want to wait for the market to come here and then maybe push to the upside, maybe. Or else we can say this is a trend line, which looks like a trend line to me. So what do? We draw this trend line, and when you draw it, you want to make sure we have 1 touch here, 2 touches, and then 3 touches. On the 3rd touch here where we are, you can see, if you know about candlestick patterns, you can see a bearish engulfing candle here, showing you that the market is likely to drop to the downside, and it's respecting this trend line. So you place your trades, put your stop loss above the trend line, and you take profit way below here. Then most likely you are going to win the trade. You can also see again that the market kept respecting this trend line for a little while before it will maybe eventually break to the upside. That's how you trade the trend line strategy. This is a very easy strategy, and it has a good win rate, and also it has a big risk to reward ratio. So your stop loss is gonna be small and your take profit is gonna be bigger, which makes you way likely to make money in the market. Now let me show you the next strategy. Strategy number 7 is fake out trading. What is a fake out trading? We talked about breakouts, but then let's look into this market. Let's say you were trading a breakout strategy here, and then you marked this zone, you marked this zone as your zone right here. But then you can see that the market moved and then went up here, right? So you could have placed your buy trades, but then this market followed down and moved to the downside, right? So sometimes the breakout is gonna work, sometimes it's gonna be a fake out. So how do you know that this was a fake out, and how do you take advantage of that? So first of all, you want to mark a zone which have got a way chance of the market breaking out, just like in a breaking out strategy. So this is a zone, and we are likely pushing to the downside right now, and the market have been respecting this zone for a little while. So now we are expecting the price to go to the downside, right? But then in this case, it doesn't happen like that. The market come back into this zone. So see, if the market breaks to the downside and come back up above the zone, it is likely a fake out. The reason why the market went below here was to wipe out the stop losses of the people that were here. That's what happens. So if the market goes and breaks out, let's say you place your first trade here as a breakout and then it loses, the most likely thing that you can do is you can place the opposite of that trade if it comes back here, and then you close the sale that you have already lost, and then you place a buy, because most of the time the stop losses of the people that are here are going to be taken. Because if you look at this chart, you are going to see that there was a big zone here. Most people were buying because of this support zone. And where are the people buying here putting their stop losses? They are putting it below the zone, right? Everyone advises you to put your stop loss below the zone. But then now, you as a smart trader, once you see this, you know that, okay, the big market players have taken the stop losses. So now it's time to go to the opposite direction, which is exactly what happens right here. Here's another example. So we see the market that is ranging. So fake outs happens mostly in ranging markets, right? You're not going to see a lot of fake outs in a trending market. If the market is already trending, you place your breakouts right here, there's less chances of fake outs. It happens sometimes, but there's less chances. But when you see a market which is ranging like this, there's a lot of chances of people being faked out, because this is when most people trade. Most people now these days know about support and resistance, and they want to trade support and resistance. So big market players know that, and then they try to manipulate the market. They try to place huge trades, and then they eat up your stop losses. Even market maker brokers who trade against you, they always try to make sure that they know where you retail traders will place your trades. If you want a reliable broker that I use myself, check out the link in the description below. Now, we can see that the market is pushing to the downside right here, and then we see a breakout of our previous zone. So this is a breakout of our previous zone, right? And then we can see now the market is coming back into the zone, meaning it have taken out a lot of stop losses here, and then the market is likely to push to the upside, trust me. And then here is where you place your trades. It's not going to be 100% of the time winning, but if you get this right, most of the time you are going to win these trades, because there's a lot of fake outs that happens. So if most people know about support and resistance and they're trading their trades based on support and resistance, most likely the brokers will know that, and then they'll try to give you this type of fake outs. And then here you can see the market pushes to the different direction. Strategy number 8 is the head and shoulders strategy. What is the head and shoulders strategy? The head and shoulders strategy is simply a strategy that shows you when the market is losing momentum and when you can take advantage of that. How do you take advantage of that? Number 1, you want to identify a strong move. So here is a big move to the downside, pull back, impulsive move, pull back, impulsive move, pull back. Now you can see how important it is to be able to read these trends correctly, right? So again, you can see market pushes to the downside, breaking below this zone, making this a new lower low, coming back up. This move here is now going up, but it fails to break past this. This is a shoulder, and this is the head, and this is another shoulder. Now we are expecting price to go to the upside. When the market fails to break this zone, it means it's losing momentum. So we want to wait for it to break its previous lows and then reverse to the different direction. So this is what happened next, right? You can see market pushes here again. So we have a shoulder, we have the head, we have another shoulder, and now we can see that the market is pulling to the upside, right? And then we are likely going to place our buy trade here. Why are we buying? Why? Because when you are reading a trend, I'm saying that I should make a complete video on how to read these trends correctly using higher highs, lower highs, and then the breakout of these structures, right? So I'll leave that at the end of this video, and I will show you the video that is about that, right? So now you can see that if we are reading trends, we said if the market is going to the upside like this, for us to know that this market has started reversing, we need to see it breaking this zone. So if it breaks to this zone to go to like this to the downside, we know that okay, this uptrend is coming to an end because this previous zone is now being broken. Some people will call this change of character, so whatever it is you want to call it, but then this is it. And then once you do this, there's more chances that the market will reverse. So let's see what happens here. Of course, it was a winning trade because this is an example. You're not going to win 100% of the time, and I'm always saying that because I don't want you to risk everything on one trade. Now let's take another example like here. This is GBP NZD. So a lot of examples that I put here was from one chart, the GBP NZD, and I wanted to show you that you can place all these strategies on one chart. So if you know these strategies, you can get the best out of any situation. Look at this, you can see we have a flag pattern that we talked about here. Market pushes lower, breaks, you could have made money. Here we have the market coming into this previous zone and creating a double top. Boom, you could have placed the trade. And then here, this is where I want to show you the head and shoulder strategy. So you can see market was pushing to the downside, created a big move here, a pullback, a big move here, a pullback. Now, if the market doesn't break here and started going to the upside, we are looking for the break of this zone for us to know that this is a head and shoulders pattern and we are supposed to be placing our trades. So you can see that the market went on to move up and now it have broken this zone right here. So this zone, our previous zone, have been broken. We can have a trend line break. You can see here, this is the same chart again. A trend line is another strategy that I showed you. So you can see that these price action patterns, it happens all the time. You just have to know, okay, now as I'm looking at the chart, which pattern is this? Should I trade it or should I just choose a few strategies that I want to go, or should I know like 5 strategies, whatever you want to do? But I recommend you to get 1, 2, or 3 strategies that you master and you use those and forget others so that you don't confuse yourself. So now you would place your trade right here and then the market push it to the upside. So the thing about this heads and shoulders pattern is that it is created by a lot of candles, right? So you need to be careful to see it. Most of the time you are going to likely miss it because you might not see it because it's created by a lot of candles as compared to double tops and double bottoms, right? So on the other side, let's say the market was pushing to the upside and it moves like this and then it makes a move, it pulls back, it makes a move which is bigger, it breaks above this zone, but then it goes below here and then on the next move, right? So the most important things here is that this move right here doesn't break above the previous zone, and also this pullback should come back, it needs to go below this, and this move right here, this zone shouldn't be above this, and then we start seeing the market dropping and we mark this zone, and once the market breaks this zone, we know that the market have lost momentum, it's time to sell, and likely the market is going to push to the downside. This is how this strategy works. Number 9, let's talk about the next strategy, which is the Fibonacci strategies. Now we are starting to use some advanced tools. So we said on the break and retest strategy, we want to see what the market pushes up, break, pushes up again, and come back into this zone. But what if we want something to confluence this zone, or else what if there is no clear zone here? We are just seeing a pullback and we don't know where the market is going to end until it reverses. What is something that we can use? We can use what is called Fibonacci. So a Fibonacci basically is a tool that is found in nature, in everything, right? So you will see that when the market is pulling to the upside and is making a reversal, what is the most important thing that you should do as a trader is to be able to mark this zone and this zone. Know this previous zone here. How do you know this previous zone? You need to be able to understand where the trend is coming from. So we start here, pushes to the upside, and then we have a retest. So when the market goes up again to create an impulsive move, we want to see that, okay, when the market breaks above this zone, what was the lowest point it went to before coming up to break, which is this zone right here. And now we are seeing a reversal. So we have this zone and this zone. That's where we draw a Fibonacci. To draw a Fibonacci, let me show you how you do it. So what you want to do is just go to your charts. Once you go to your charts, you go to your drawing tools. If you are using trading view just like me, if you are using MetaTrader, it's just there. You're just going to come here and then you find Fibonacci retracement. Once you find this Fibonacci retracement, you touch where you want to come from, right? So if you want to come from here going to this zone right here, you can draw that. So from the start of where the move is, and then you use the entire impulsive move, you cover the entire impulsive move, and you are waiting for a retest, right? Now, so if I draw the Fibonacci, I will just touch from here and I would drag my Fibonacci from this point to the downside. So let's do that. Let's draw here the Fibonacci. So you can see this is the 0, this is the 1. So you touch from here and then you drag the Fibonacci coming to this. You are automatically going to get these zones, and then we have bigger zones to the upside. And this is what is called the Fibonacci tool. So where do you place your trades? You can see the Fibonacci, you've got different zones: 0.23, 0.3, 0.50, sorry, 0.61, 0.78, and then the 100, right? Or 1. So what you want to do is you want the market to come into this zone, which is between 0.50 and 0.61. This is called the golden zone. So if you hear people talking about the golden zone, it is this zone, because when the market makes an impulsive moves and it pulls back, it will likely come to this zone. And most times this zone also is going to have a confluence of another zone that is here. So in this case, you can see this is our golden zone, and also we have, it is a very strong zone because it has been tested multiple times. Now we place our trade right here, and then we expect prices to go to the upside. For the take profit, you can take profit early, or you can put it on the 1.61 here. If you are on trading view, you can also edit these numbers. You can add another zones right here. If you want to get a free trial of trading view, I will leave my link to the Telegram group where you can get all the resources, and also you can get free trading signals and setups using these same strategies that I'm showing you. So check out the link in the description below. Now let me show you another example. Look at this market and you see that the market is moving in an uptrend. Why? Because from here I see an impulsive move, a pullback, an impulsive move, a pullback. Don't overcomplicate this. Once you see a 1, 2, 3 move like this, it's an uptrend, because you can see impulsive move, pullback, impulsive move, now another pullback. I'm expecting prices to go, but is this where the market is going to reverse on? Let me confirm with the Fibonacci. Go to your objects, drag out the Fibonacci and touch from this zone, the top here, to this zone, because this is the lowest zone that the market went to before breaking past here. So we touch from here to here. So I'll do that and I'll draw my Fibonacci. So from here to here, and what do you see? You see the market pulling back into what? Our golden zone, which is the zone between 0.50 and 0.61 here. And when you see that, you are going to place your trades, and then the market pushed to the upside. Your trade was going to look like this. It also went to the 1.61 zone right here. This is called the Fibonacci trading strategy. So this is a very big topic, and likely if you want me to do a complete video on that, make sure you comment below and tell me to do that, and I'll do a complete tutorial on Fibonacci. Now let's move on to strategy number 10, which is the 1, 2, 3 reversal strategy. 1, 2, 3 reversal strategy, I talked about it many times here, but maybe you didn't know that it was a strategy on its own. We said if the market is making impulsive moves and pullbacks like this, right, we are looking at these zones and we are interested to see that if the market is going to reverse, it should break this zone. So if that can happen a lot of times, let's put that into a strategy, which is exactly what I'm about to show you. So let's see this market right here. It creates these zones. So you can see here, it's creating these zones. So for us to say that the market have reversed, we want to see a break of the previous one, which is exactly what happened right here. So once you see this break, you can place a trade right away and expect the market to drop, or either this market is going to push to the downside, come back into this zone, and then that's when you place this trade and then you make profits if the market does this and pushes to the downside. So you can see that here the market pushes to the downside and you made profit. On its way to the downside again, look, you can see push back, impulsive move, pull back, impulsive move, pull back, impulsive move, pull back. So if the market breaks to the upside, what are we likely to see? We are likely to see the market breaking here, and then if it does, that's when we place our buy trade, because we have confirmed this reversal. You can see, let's move the market more further again. You can see here it went on to break this zone. Now what do? You place your trades. Why? Because this is the same chart, by the way. You can see here it moves like this. So we are breaking this previous, so it means the trend is reversing. So if you want to take advantage of that, it's time to place your trades, and likely you were going to place your winning trades. It's called the 1 2 3 reversal strategy, right? We want to make sure that we see the 1 2 3 move before the reversal, so that we know that it was an uptrend or a downtrend, and now it's time to reverse. So I'm talking about a 1 2 3 move like this: 1 2 3, or either we have 1 2 3, and now we can see a breakout of that zone. That's when you place your trade. Now let's move on to the 11th strategy, which we are going to add one indicator, even though I said this is price action strategies, but I want to add one indicator to the charts and show you a very good strategy that you can use. But before we do that, let me show you one more example of the 1 2 3 move trade, right? So look at this. You can see the market has been moving to the upside, and if you can really read the trend, you can see it look like this: push to the upside, then reversal, push to the upside, we break this zone, push to the downside, push up here, break this zone, push here, go to the upside. So we are marking these extreme zones, and for us to confirm a reversal, we want to see a break of this zone right here, which is exactly what happens. So once we mark this zone, we want to see a break, and then if that happens, we sell, and we expect prices to push to the downside. Why? Because this is no longer a pullback. It's now becoming an impulsive move, because it's very big. It's breaking previous zones, and likely it will have small moves within it. That shows you a reversal of the market, and here the market pushes to the downside. Now let's go to the 11th strategy, and let me show you how it works. So the indicator that you are going to place on the market is the RSI. Why? Maybe you guessed it, because I'm about to show you the divergence strategy. So the divergence strategy is when the indicator, like an RSI or a stochastic or a MACD, any momentum indicator, is showing you different momentum when the price action haven't showed you that yet. And then you are likely going to win your trades if you place it like that. Why? Because look at this. This is an uptrend, right? If you are trading price action, the first thing that you are looking at is trends. Second thing you're looking at is areas of value. Third thing you're looking at is candlestick patterns. And then you can look at other tools like trend lines and all the stuff that I'm talking about, right? But then the first thing you want is to read a trend. So here you can see the market moves like this, right? It's breaking its previous zones. But then if you look at this, you can see, okay, we are still in a strong uptrend. But if you look at the RSI, what does the RSI does? The RSI measures momentum. And what is momentum? Momentum is the amount, the average gains over the average losses. So if the RSI is going to the upside and goes over the over 70 zone, most people will say it's oversold, but I would say it shows you that there's a lot of momentum, right? So what if the market is moving like this? It makes a pullback right here, it moves again. the market is showing you that here we had very big momentum, right? But then when we create a new high here, if the RSI started showing you that we have less momentum here than we had here, what does that mean? It means this move is not strong enough than this move, so we are likely going to reverse. So you are going to draw something like this. If you see that you can draw an upper trend line which connects this previous higher high and the new higher high, but then on the RSI, this previous higher high is upper or higher than this next higher high. So the price is showing you a higher high, but the RSI is showing you the opposite of that. What do? You want to place your trades. Also, you can also add things like waiting for the break of this higher high, as I said, in the 1 2 3 move, and then wait prices to go to the downside. But then now we have more confluence because the RSI is also showing you the same. So you would place your trade right here and expect prices to push to the downside, which happened eventually. Let me show you another example. Look at this. You can see the market is pushing to the upside right here, and then you can see this was a higher high, and now we have a new higher high. But on the RSI, on this zone right here was overbought, which means there was a lot of momentum. But this is a higher high, but it is now below level 70. There's less momentum here, less buying momentum than there was here, which means if there's less buying momentum, what catches on is the selling, because after buying momentum we get into selling. So you would see, if you can draw something like this, higher high, and then here we have lower low. So price is going up, market going down, indicator going down, then likely we are going to reverse. So you place your sell trades, put your stop loss above this zone, because if the market goes and break up, you are continuing the uptrend, so you want to get out. So here you can see market dropped to the downside. Something can happen on a lower side. Here you can see the market was pushing, creating lower lows, but if you look at the indicator, it was already going to the upside. So the market, so what would end up happening here is that we have a trend line which looks like this here, and then here it looks like this, which is the opposite. So you would want to buy after this zone and expect prices to push to the upside. So this was a very big lesson for all of you, and you can now see that you can take advantage of any situation that you see in the market. If you think this lesson was helpful for you, make sure to smash the like button, comment below, and if you are new to the channel, subscribe to the channel right now. I'll give you 3 seconds to do one of those things. Okay, I hope you have liked the video, or either subscribed, or you are still commenting on the video. As you do that, make sure to watch this video coming up next if you want to know how trading psychology can help you to become a successful trader. I'm going to show you 5 things that makes you blow your account and what you can do for you to become successful in the market. Check it out, and I will see you in that video.